Hello everyone and welcome to today's webinar. This webinar from now on is being recorded and we will discuss about proper money management in Forex. This is the agenda for today. We will kick it off with a small introduction, then we're going to discuss about price action versus mean reversion, then we will discuss about account sizing, then about how to set risk levels when trading in FX, then currency trading dangers, and then we will close with the Q&A session. Here's a short disclaimer. Please go through it in the next 30 seconds and then we'll be able to continue with the webinar. Thank you. Okay, let's move on now. So, a short introduction. We are Blue Sky Forex, which is part of Blue Sky Binary, an education, research, and trading group. This group comprises of senior traders that teach various strategies in Forex and binary options, and 24-hour trade support and analysis to allow binary option and FX traders to trade safer. And the word safer is the key part here, okay? Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you, the traders, and help you become profitable currency traders. So after this small intro, let's discuss a bit about the markets. So price action versus mean reversion. These are the two types of strategies in currency trading. Price action is a lot more powerful. I'm sure that a lot of you might have come across the expression that trend is your friend. So although price action is very powerful, it is kind of difficult to identify when the trend is actually valid, since it needs to be fueled by news in order to carry serious weight. So a lot of times you will see the price moving to a certain direction, but then that just seeing the price moving to one direction is not enough. You need to be checking the news, you need to be checking different time frames, and also just to be sure that it has serious weight. So before you enter a position. So just seeing the price going to one direction is not enough. You need to be certain that it's fueled by news in order to be able to place a trade in that direction. And that's what price action trades mean, placing a trade in the direction of the existing trend. Now, mean reversion is more common, it's easier to identify, but can be profitable too. So basically, as we discussed before, in a similar situation where the price moves towards a certain direction, but it is not fueled by news, then most likely it's gonna lose weight and actually gonna revert back to the previous price level. So it's gonna revert back to the mean. That is why this is called mean reversion. All types of strategies that fall into the above categories require very sound risk management procedures on your behalf in order to ensure you're not hit by a margin call or face a counter. And we will get into these details very shortly. So basically what we will discuss today applies for any types of trades that you take, either these are price action or mean reversion. Now, first of all, let's discuss about how you could determine your account size when starting to trade in FX. Now, let's start by saying that having too little money in your account can pose a problem. And the problem is, I'm not saying that you should have too much money, but let's start with, we need to tackle one thing at a time. So let's start with having too little money. So the psychological impact of working hard to win trades, but then not making enough dollar profit out of it on the payout could lead to overtrading, because you see, you trade, and then because you're not seeing enough return. You're spending your time, you are investing your time in actually making trades and studying the markets, but you're not getting back a big return. That's why you tend to trade a lot in order to compensate for the small amount trades that you're placing. So this could lead to overtrading, which is one of the leading causes of account ruin. Okay, so that's one of the reasons why having too little money in your account is not such a good thing. Also, small capital balances can result in trades being taken that are too much percentage of your total balance, which means excessive risk. remember that when we'll discuss this later, but when we are actually taking a trade, the risk, you should not be investing more than 1 or 2% of your total account size. I mean, if your stop loss is hit. So if you start with a small account, in order for this to make sense, you will need to be, for trading to make sense, you will need to be trading too much of your total balance, right? You cannot start with an account of 500. You cannot be. It's very difficult to limit yourself to a loss of $10, let's say, or $5, which is equivalent to 1 or 2%. So when you start using too much money, then of your balance, then that becomes then you start trading at an excessive risk. So that's a bad thing as well. Now, a good amount to start with is around $5,000, and certainly not more than 30K. Anything over 50K may result in lack of respect for your capital and taking more a disciplined trade. This depends on whether you are a retail or institution trader. If the latter, your AUM can be a few $100,000 if not larger. But for you retail traders, it shouldn't be more than 30K, and that's even a lot of money. Okay, so you need to be very careful with your capital. Always size your account relative to your total personal equity. Risk capital should in general not represent more than 20% of your net annual value. So please be very careful when you're selecting your account size. Okay, don't go with too much money, but don't go with too little money, and always start with a demo account. Okay, this is very important. Don't start trading immediately with a live account. Always go with a demo account first. Now, determining risk levels. There are 5 things you need to take into account when determining risk levels in FX: leverage, the risk-reward ratio per trade, the maximum percentage exposure, the correlation risk, and the event risk. Now let's discuss about leverage. Leverage determines how much funds you can borrow from your broker on every trade, given your cash balance levels in your broker account. So for example, if you have 100K cash equity in your broker account and have leverage set 1-to-1, this means that you are not trading on margin and cannot receive a margin call. If you open a 100K position, long USD JPY, and the USD moves up by 1% against the yen, the gain on your capital is $1,000 or 1%. Remember, the leverage is 1-to-1. If, however, you're using higher leverage, for example, 5-to-1, 10-to-1, 20-to-1, then a 1% rise in the US dollar yen will result in a higher percentage move in your account. But here's the interesting thing. This works both ways, and if the USD yen moves against you, then you can suffer losses greater than the equity invested in that trade, i.e. receive a margin call. This can result in your positions being closed automatically by the broker. Please note that the best traders use 1-to-1 to 5-to-1 leverage. 10-to-1, 10-to-1, 50-to-1, 100-to-1, or 400-to-1 is extremely risky and is not recommended. So please be very careful when you're selecting the leverage on your account. Risk reward. Now, before buying or selling lots in a currency, it is important to set your risk and reward per trade. This means that actually you need to divide your potential gain in pips after you take profit, after your take profit level is potentially triggered by your potential loss in pips. So your stop loss level be hit. Generally, aim for a risk reward ratio of 2-to-1. So if your potential gain in pips is 20, then your stop loss should be 10. Okay? So 2-to-1, if your potential gain in pips is 20, then your stop loss should be 10. Okay, this is an important thing. The risk reward should not be close to 1 or less. However, depending on if you are a short-term scalper or duration trader, your risk reward levels will naturally vary depending on your appetite for volatility. Duration trades means higher volatility, so more headroom required on the stops. When your positions on duration trades are in profit to a desired level, then you may wish to consider moving your stop loss, dynamic stop loss, or trailing stop loss management in order to lock in ensure gains with zero downside risk. Now, this is something that, if you're not aware of, the trailing stop loss, this is something that you should look into before you start trading with real money. This is a strategy that you can use the trailing stop loss in your trades, and what it will help you do is basically lock in profits after the price has already moved in your favor. Okay, so this is very important, and please consider using this. Now, a lot of people will say, okay, I've set up my leverage account, the leverage on my account. I am taking care of the risk-reward ratio. I know how much stop loss and take profit I'm going to use, but how about the amount that I'm going to trade? Now, let's discuss about this. It is important to set your trade dollar amount so that your capital is protected and that no trade is more than a certain percentage of your total capital. Determining the appropriate percentage can be done mathematically or manually by assigning a manual stop loss at X%. For less experienced traders, we suggest that no single trade setup should cause a loss greater than 5% to your total account equity. For more experienced traders out there, we recommend considering the Kelly risk management criterion that uses historical success rate profit factor per trade to determine a percentage risk level. But always, if the output is more than 5%, be mindful that a manual stop loss of 5% is preferred. This is the Kelly formula here. And W is the win rate percentage, and R is the profit factor, historical profits over historical losses. So if you're an experienced trader, then most likely you have an audit record of all your trades, so you can find this information here. But if you are not an experienced trader or you don't have this record and you cannot create it, then you can stick by the maximum 5% of your total account equity. Okay, this 5% is very important. Don't exceed that. Some would say even less than 5%, but keep 5% in your head. Determining risk levels. Let's discuss about correlation and event risk. Now, entering multiple currency pairs, for example, long USD JPY and short Euro USD, poses correlation risk as the two pairs are inversely correlated. So you see, because if you see the pairs USD JPY and Euro USD, both have the USD currency inside them, and they're inversely correlated because in the first occasion USD is at the left of the pair and the Euro USD is at the right, so it's the second pair. So they're inversely correlated somewhat. Okay? It's recommended to short-term or scalp trade on the majors Euro USD, USD JPY, GBP USD in an uncorrelated manner. Trading low liquidity peripheral pairs could impact your ROI owing to cost of positions in terms of spread. So please note that the less liquid the pairs, the more the spread that you will face. For duration trades, this is less of an issue, but correlation should be avoided because basically, when you have a correlation in your chosen currency pairs, this actually means that you are doubling up your risk unnecessarily. If you have already taken a position on USD and JPY, for example, then there's no reason to take a second position on USD again. Okay, so whether you're going in the same direction or in a different direction, then it's doubling up the risk unnecessarily. And especially if you're going with inversely correlated pairs like this one, you should be very careful. So long USD JPY and short Euro USD, this means that you're heading that USD will go up in both pairs, which is okay because you're trading on the same direction of the USD movement. But if you were trading long USD, but again, this should not take place because you're doubling up your risk again. But if you were going long USD JPY and long Euro USD, this means that you would be taking opposite positions of the USD. So please be very careful. Don't trade correlated pairs. A good place to see which pairs have the highest levels of positive and negative correlation. Please Google correlation heatmap and you can find free widgets and tools on the web which can help you determine which pairs are correlated. This is a very helpful tool, so please do a very helpful exercise. So please do it when you are about to start trading or where you are trading. As for event risk, when entering a trade, ensure that you are aware of the economic calendar, that no major events will trigger your stops prematurely. So this is another thing. At the beginning, we discussed about news, okay? About price action and mean reversion, and how if a price movement is fueled by news, it's very important to keep in mind when you're actually taking a trade. So the same is important about news, that before you actually enter a trade, you need to check the environment and the economic calendar and see if you are about to receive some major news. So if you are about to receive major news, then you should better wait for them and wait for after they go out and after 10 or 15 minutes and you see how the market plays out, and then you enter the trade, because you don't want to be caught up just with a position without taking into account news coming up, because it will be like gambling basically, and you don't want to do that. Now, a very common practice engaged in currency trading is martingale. This is extremely risky and not recommended at all. Dollar cost averaging is gently building a position in a rising or falling market in order to get a better average price. This is safe, dollar cost averaging. But outright doubling of positions is a recipe for account ruin. This is what happens when you're martingaling. Martingaling means that you're doubling up your positions when you're at loss. So to not do that, it's a certain recipe for disaster. The reason is that the market can stay trending in one direction for years, which is a lot longer than you can stay solvent. So no matter what, avoid using grid trading or martingale strategies, because the market can keep moving against your trade for a very long period of time, which is more than you can actually stay in the trade. Now let's discuss a bit about currency trading dangers. First of all, do not trust bots. 99% of them are scams that are driven by affiliate marketers that are not traders. Expert advisors are very dangerous and very few work on a longer term basis, so be very careful. 5% of traders make money in FX in the long run, so understand that in order to beat the markets for a living, you need to take time to understand the strategy and the system. Otherwise, you're just gambling. Blowing your account is not a bad thing. It's part of every trader's journey to eventual success and teaches you the flip side of making trades, namely money management. Start small, set leverage level small. So basically, this is something important that I don't want you to misunderstand. All the traders that have traded an account in Forex have blown their accounts. It's something that happens to traders, and it's part of the whole journey that you're taking. So yes, you will blow your account eventually at some point, but you should, if it's done at the beginning, if you learn by this, if it's done at a small amount, that's why we always say start small and set leverage level small. Then you just, the lesson that you will get is worth a lot more than the actual money that you're losing. So please be very careful. Always start small. Keep in mind that you will eventually, at one time in your career, in your trading career, blow an account. But this is something that you will learn from it, as you will learn dealing with all the emotions involved. Okay, so but always, before you even start small, start with a demo account. Now, last but not least, I would like to inform you that around 5% of signal services and signal rooms are legitimate, so be very careful when you invest your money into them. Always ask for a performance record and an audit trail. Always, before investing your money into any of these rooms or services, always ask for a performance record and ask for a free trial as well. See on a demo account, see if they will give them to you. If they do, then you can check out the performance and then judge accordingly. Okay, so this is for today. It's now time for questions. If you have any further questions, then you can address your query to webinars@hotforex.com. Please note that this webinar has been recorded for everyone that joined us right now. This webinar has been recorded and will be available to you inside your Hot Forex panel. So I'm opening up the room for questions. If you have any question, then please type it in and I will get back to you right now. Okay, so I see a question from John. Let me just get to the slide. Okay, John, here's the Kelly risk formula. Again, this is W stands for the win rate percentage, and R stands for the profit factor, which is the historical profits over the historical losses. So this formula here can help you determine the percentage of your capital that you can risk when you're taking a trade. For those of you that are not experienced traders or you do not have an audit record, then please know that you should stick to the 5% upper limit for every trade. I hope this helps. Thank you, Chitty, for your comments. Okay, everyone, I see no further questions. So I would like to thank you for taking the time to be at this webinar. Please know that it has been recorded and it will be available to you in your Hot Forex panel. If you have any questions, please, you can send them to webinars@hotforex.com, or if you would like to contact us directly, you can send us an email at support@blueskybinary.com and visit our website at www.blueskybinary.com. Thank you very much for your time today. Have a nice day ahead.